Hello and welcome to our end of June update from the Wealthy Doctor Institute. Intelligent investing for the busy professional. We focus on simple battle-tested methods of investing that require just one adjustment each month to protect and build wealth. I'm David Ye, author of my book, The Busy Doctor's Investment Guide, How One Adjustment per Month Can Save and Maintain Your Portfolio's Health. Although the strategies in this book are easy to calculate and adjust each month, for those who are new to the concepts in this book, or for those who are just new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. And here we are, halfway into 2015. We have several new followers who are wondering how our systems are doing so far. Let's update. So, we'll start with a 20-month moving average system, then we'll review the MRI system, and then we'll briefly look at the Ray Dalio portfolio. No, I didn't write about the Ray Dalio portfolio in my book. It's been written up in another book, but it's one of the few portfolios out there that I haven't been able to improve substantially with my techniques, and it's worth following, depending on the tax situation. And of course, we'll review the rules for dealing with a stock tip, in other words, the 25% trailing stop system. So the 20-month moving average system is just a one-rule system, and here's the rule. You take the most popular U.S. stock index, the S&P 500 index, and calculate the average closing price over the last 20 months. And if the index price is bigger than the moving average price, you're in stocks. Otherwise, you get out and invest in something else, such as cash or bonds. Now, this is how I translate that rule into something that's visually intuitive for me. You see this black line of the index, represented here by the Vanguard S&P 500 Index Fund, ticker symbol VFINX. I give you the ticker symbol so you can easily look this up online. There are many free websites out there which will calculate this 20-month moving average quickly for you. To make this video, I do this using freely publicly available data and plotted using a spreadsheet to let you know that there's nothing magic about this. So let's look at the data. Yes, if you were listening to the news and all the news about how Greece and Puerto Rico and Illinois can't pay their debts and how it's the end of the financial world as we know it, and experienced a big drop last week, well, true, you can see on this graph just how big that drop really was. The VFINX mutual fund went down from 194 all the way to 190.36. Meanwhile, the moving average went up from 178 to now 180.56. So, do the math. The S&P 500 index is still above its moving average, so go ahead and stay in the S&P 500 index for now. The good news is, no matter how much the news media tries to scare us into doing something stupid with our investments, as long as we keep in mind ultimately which data is really important and which is just entertainment, keep in mind that the index is still above the moving average. In fact, you don't even need this graph to tell you the index is still above the moving average. All you need are these two numbers. The price of the index fund or the mutual fund and the price of the moving average, and you know which number is bigger and what to do about it. And for those of you who are just kind of curious about how close we're getting to that trigger where we have to sell our stocks, 190.36 divided by 180.56 is a 5.4% cushion. That means if the S&P 500 drops 5.4% next month, we're out, but not before. Let me emphasize that. I know at least a couple of you want to jump the gun, but let the system make the decision for you. The system doesn't run on adrenaline. The system doesn't think, and the system doesn't worry. The system just is. So how is the 20-month moving average doing so far this year? Well, so far, the mutual fund has gained 0.73%, basically flat, and yet technically I have to tell you that the system only made 0.23%, even though we haven't budged from stocks since 2010. Why is that? Again, this is one of those quirks of regulation. I'm technically a financial professional now, so even though the purpose of this video is education. Because I actually use these techniques myself and for my clients, regulators classify my videos as advertisements, and thus all data I share must be net of all fees. So, even with the fees, if you take a look at just the last 10 to 20 years, because we've been able to avoid much of these bear markets from 2000 to 2002 and 2007 to 2009, we actually smoothed out the graph and made more, so far almost twice as much more. But wait, what happened here 5 years ago? Looks like the system severely underperformed the index fund. The fund did 68% and the system only did 41%. True, and this shows a whipsaw right here. Getting out one month, getting back in another month can have devastating consequences. When back here in September of 2011, we did have one of these whipsaws. This is one reason why frequent traders tend to lag the markets. There are these whipsaws that drag down performance. And here's that same data in chart form. I'm getting feedback that some people don't like line charts and prefer data in table format like this. Or whatever helps you see, hear, feel, and process the data, I'm here to help. So you can see the columns of numbers comparing the actual return, comparing the index fund itself, the VFINX, and what happens if we apply the 20-month moving average net of fees. Out of the last 27.5 years, the system had 3 down years so far, compared to buy, hold, and pray, which had 5 down years, 3 of which have been double digits. Here's the effect of the 2011 whipsaw, right here, which barely registered as a significant blip on the line graph. And at the bottom of the graph here, you can see the analyzed returns. Remember, these are not mathematically average returns. If you were to take 1 year that went up 50% and 1 year that went down 50%, the mathematical average would be 0%. However, if you had $100 and went up 50%, that's $150. And if the $150 went down 50%, you only end up with $75, or net loss of 25%, which is a 13% annualized loss. Just keep that distinction in mind if you talk to other fiduciaries and fund managers. Make sure you get an annualized return. So the annualized returns here only result in less than 2% difference per year, but over almost 28 years, if you invested a hypothetical $10,000 in 1987, a huge number in 1987 dollars when a McDonald's Big Mac cost $1.60, you'd get a hypothetical return of $139,000 just by holding and praying the S&P 500 Index Mutual Fund, reinvesting all dividends, which is a huge number, $2,015, and a hypothetical $223,000 if using a 20-month moving average system, an even bigger number. A 2% annualized difference can mean a huge amount over the years. Time is your friend when investing early, and even if you wish you started 10 years ago, if you're not already investing, 10 years from now, you'd wish you started today. 10 years can go by in a heartbeat. Those of us with kids know and keep asking ourselves, where did the time go? So, what's the big takeaway about all this? Here's the lesson of the month. Stick with the system. I don't care which system you use. If you choose it, stick with it. If you change your system by adding a rule, disregarding a rule, switching from one system to another, then you're not following the system. You may be following a system, but not the one you committed to when you first committed funds. To this day, I get people asking me, but what about diversification? Shouldn't I be buying something else at the same time? Shouldn't I stick some funds into international funds? Do you think it's a good time to buy Greek stock? Gee, the market started crashing last week. Shouldn't we be getting out now? Or gee, the markets crashed last week. Shouldn't we be buying more? But this pundit on TV said this, and maybe that YouTube group say that. What should I do? Stop. Please stop. All those questions just mean you haven't committed to a system yet. Think about this analogy. When you're looking at systems, you're dating. You're enchanted by returns of some market analyst. You analyze the data when you're dating, and then when you commit your funds, you're marrying your funds to the system. If you subsequently cheat on your system by doing something the system doesn't tell you to do, or not doing something what the system tells you to do, then you don't really have a marriage. Sure, you can probably hide the infidelity from your spouse. I don't recommend it, but you probably can. But let me tell you, the markets is a harsh environment. The system helps protect you from at least some of the cold, hard realities of the market. But if you cheat on your system, the system doesn't have a mind. The system doesn't have a heart. The system doesn't care if you follow the system or not. But the market will punish you for your infidelity transgressions. You might get lucky once or twice, sure. Might. Remember, once you have funds committed, all rational thought goes out the door and decisions start to become based on emotions. Remember, systems do not have a mind and are not swayed by adrenaline. They work only because we did our thinking and planning before we committed a single dollar into battle. So here's our second system, the MRI, or the Monthly Rotation Investment System. There are two rules. Rank 3 funds, then make the adjustment of rotating 25% of our portfolio into the winner of the month. Yes, the markets change, and the markets can only go in one of three directions, up, down, or sideways. By definition, if we have an inverse fund, the inverse fund goes up when the S&P 500 goes down, and vice versa. So, by definition, there's always something going up. Detect that stronger dominant trend and start rotating into it. But wait, you might be asking, didn't I just show you that whipsaws, that nasty habit of selling one fund and buying back the next month, is actually bad for accounts? And if you're astute enough to recognize this, then yes, you got it. That's why we only rotate a quarter of our fund each month. If a true trend change happens, and say a multi-month bear market emerges like it did in 2000, 2002, and 2007, 2009, then yes, we would be likely catching it within 4 months of developing. But that does mean that when there's no strong trend either way, yes, we will get whipsawed. A good follow-up question would be, yes, we lose money when we whipsaw, and yes, we lose money if we don't catch the big underlying multi-month bear market fast enough. Do the small losses of the whipsaws using only a quarter of our portfolio, are they small enough to disrupt our overall gains? Let's look at the data. So here's a graph using all the data that's available since 1994, adjusted for dividends and fees. And you can see over the last couple of years, the system has been going down, even though the S&P 500 stock index has been drifting up. In fact, the MRI actually lost 4.5% when the market's been relatively flat. And yes, during the last 5 years, the MRI has not been doing as well as the markets, 23% versus 119% for the last 5 years. Does this seem to say that the whipsaws are overwhelming our safety net? Let's look at the yearly data in table form again. So this is the same data in table form. Yes, there are patterns. For instance, when the stock market, represented by S&P 500 index, goes up, the MRI does not do as well, but in general still goes up. And yes, the MRI can have down years as well. And if you compare the down years to the down years of the stock market, the down years of the MRI are nowhere as bad as the stock market, and in fact, during the years of the worst losses over the last 20 years, the MRI actually made money. Remember, the system isn't designed to hit the ball out of the park. It's designed to more consistently hit singles and doubles rather than swing for the fences and striking out. Overall, the annualized returns over the last 20 years again improve upon stock market returns by more than 2%, which means that a hypothetical $10,000 invested in 1995 would be up by $100,000 by now, compared to $55,000 we just bought and held and prayed the stock market index. And several of you have heard me say that I use the MRI as my workhorse. Why is that? When we compare this MRI system to the 20-month moving average system, a completely different system, the two seem to do about as well on average on an annualized basis. And yet, when the markets are going up like how it's been doing the last 5 years, Isn't it more comforting to know that we're fully invested in the market and going up as the markets are going up? This is the hardest concept I can try to explain. As investors, our psychologies often work against us when live money is on the line. In hindsight, yes, the last 5 years have been amazing. And yet, for the last at least few years, to this day, I keep getting questions about, gee, the markets have already gone up so far. Isn't a market crash imminent? Some pundit on TV is saying the markets are going to crash. Some guru says the sky is falling. Guys at the water cooler tell me the zombie apocalypse is coming. Should I even be in the markets right now? And yes, following an emotionless system takes the fear and self-sabotaging tendencies away. And yes, each system has strengths and weaknesses. No system is perfect, and in fact, the simpler the system, the easier it is for day traders and big institutional traders to trade against us. Both the 20-month moving average system and the MRI system have their own strengths and weaknesses, and the strength of the MRI system is that it can handle the relative strength of more than just two funds. I've used variations of the MRI to tear apart static pie chart investment schemes. In the long run, either system mitigates the weaknesses of the straight index fund, and it would be wise to diversify not so much in asset classes as it would be to diversify systems. In other words, run one system on one account and run the other system on another account. If Mr. Market ever finds and exploits the weaknesses of any one system, at least you still have another system keeping you relatively safe and growing over time. So here's this month's data. Last month, the S&P 500 index decreased by more than 2%. The emerging markets, more than 3%. The short fund increased by almost 2%. This month's winner is therefore the inverse fund. So last month we were already a quarter in the inverse fund and 3/4 in the index fund. If we were to sell the bottom 25% of our portfolio, that would be selling a quarter of our portfolio's worth in the index fund to buy the inverse fund with that fund. And so, for those of you who recognize that one index fund essentially cancels out one inverse fund, last month we were in 50% cash. Now, we can be in equivalent of all cash. Yes, this month we are not only all in cash, but we saved a commission by just selling the rest of our index fund. And yes, one system, the MRI system, says sell everything. And one system, the 20-month moving average system, says stay in stocks. Well, who do you listen to? Yes, whichever system you choose. If you're following the 20-month moving average system in one account, stay in stocks for that one account. Don't sell stocks just because the MRI system says to sell everything. Remember, do not mix systems. If you have an account for just the 20-month moving average, stick with that one system. Do not cheat on your system. If you have an account doing just MRI, then just do MRI with that account. And yes, I'm going to touch base on this Ray Dalio pie chart. Remember how I said I can pretty much find the weaknesses of most pie charts? Most pie charts are based on modern portfolio theory. And for technical reasons I won't go into now, modern portfolio theory has glaring weaknesses. But this pie chart is different. Those of you who are not familiar with Ray Dalio, he's a legendary hedge fund manager with credentials too numerous to mention here. Suffice to say, among traders, he's a huge name. The way he constructs his portfolio is based on only two factors. The fact that economic growth and inflation are two independent factors that affect certain asset classes differently has led him to balance his chart to reflect the effects of the economic environment. It was written up in Tony Robbins' book, Money Master the Game. A great book for beginners, by the way. It looks thick, but it's actually a quick read. I backtested this particular model, and I have been so impressed with it that I'm sharing the results with you for consideration in terms of diversifying your strategies. So here it is. 30% stocks using the VFINX as a ticker symbol to calculate. 15% in intermediate term treasuries using the VFITX. 40% in long-term treasuries using the VUSTX. 7.5% in gold using the GLD. and 7.5% in commodities using the DJP. And here's what we get. Out of the last 22 and a half years, only 4 down years. Every single down year has been less than 3% so far. Granted, this year is half over and pretty much most markets are flat, except maybe the long-term treasuries and the commodities, hence so far a negative year this year. Looking at the graph, if we plot all the components of the pie chart, we see that this heavy black line is what we get. Yes, it's true, the results can never be as bad or worse than the worst fund in the portfolio, but can also never be as good as or better than the best fund. But overall, if you look at how smooth this line is, those less than 3% losing years are barely noticeable on the chart. And because this portfolio rarely trades, except mildly at the end of the year when we rebalance, it's fairly tax efficient, something to consider for a non-retirement account. And the trailing stop loss method for buying an individual stock on a stock tip or rumor. Again, if you're buying a stock, monitor at least weekly and keep ratcheting up the stop loss order if your brokerage doesn't already do that automatically. And if the stock goes up 33%, remember to buy more. So in this video, we've been going over our basic strategies I use in my own accounts and accounts of my clients. They're not hard to implement, but they do need discipline. Discipline to actually do the calculation every month, takes only a few minutes, and then the discipline to carry out the consequences of the calculations. Your emotions will sabotage and cause you to cheat on your systems. Don't do it. Stick with the system. And until next month, invest safely.